Hey everyone, this is Jacky here. We're back with another video. For this week, I want to talk about incorporating. We're going to start off with the basics to really just talk about what is incorporating, who should be incorporating, when you should incorporate, and why you're incorporating. And after you do so, how should you be investing that money inside a corporation? So if you're someone right now thinking about incorporating or just incorporating or simply don't know what is the advantage of doing so, then this video is for you. If you have already incorporated for a long time and you know what you're doing and you're looking for something a little bit more advanced like estate planning or income extraction for long term, then this video is not going to be for you. I will be making other videos. This is likely going to be a series in the future that is a lot more advanced. Okay, so this is really about the basics. Before we do that, make sure you help me like this video and also subscribe to the channel if you haven't already. A lot of my viewers actually are not subscribed, about 80% of you. So if you can subscribe, that would be great. It can help us out a lot that way. All right, so let's dive into this week's video and look at incorporation. So let's start off with the easiest topic and let's talk about what is incorporating. Now, when you're incorporating, basically you're creating a separate entity and continue to do business that way instead of using your own personal name. You want to do that because it does create various tax advantages and some of a legal protection. Now, this entity is best to think about it as a combination of a person and a real estate. It have both characteristics. This entity is like a person in a way where it can sign and enter contracts, it can pay employees, it can pay tax to CRA just like a person, it can also get sued like a normal person. And it is like a real estate in a sense where it can be owned by multiple people or even trust or even a corporation because again, corporation is treated like a person, so just like a person, it can own other companies as well. Now, there are some confusing terms that I want to be clear first before we move on. I hear this all the time whenever a client is thinking about incorporating and they throwing me some questions right away. Usually they ask things like, hey, should I start an LLC or Inc. or a corp or a group? Like what kind of ending word should I be using when I'm incorporating? First of all, other than LLC, which is only a US specific type of corporation, limited liability corporation, we actually don't have that in Canada. Anything else like LTD, Inc., Corp, Group, they are basically the exact same thing. There is only one type of corporation in Canada. So no matter what you try to call it at the end, it is still incorporating, it's still a corporation. It's no different than each other. However, you may want to use different ending words to suggest or be clear about what this corporation is trying to do. So for example, a doctor that is incorporating for his practice is going to call his corporation a medical corp, whereas a company made to hold just investment in real estate is going to be called either a real estate corp or a holding company or holdco. But this has more to do with what you decide to do within the corp after opening it. The act of opening a corporation, it's all the same and there's only one way of doing it in Canada. Now, so speaking of opening a company, let's next talk about where do we go to get a company started. Now, basically what you want to do is first pick 3 trade names or company names that you thought of and that you're interested to have it as your own official name. You're going to be submitting that to a government. And then next, you can either choose to do a DIY path or use a lawyer to set everything up. Now, setting up a corporation, even using the DIY path, is actually quite simple and it's definitely doable, and it will only cost you anywhere from $200 to $400. And a lot of people actually prefer to do it this way. However, from a financial planning perspective, unless you know for sure that this corporation is going to be extremely simple, only have maybe you inside, but if you're anything other than that, or you're not sure how this company is going to evolve over time, then I really recommend you going through the lawyer path to make sure you set everything up correctly. Because more often than not, I see clients wanting to add partners or investors or even their spouse inside a corporation. And this requires pre-planning to make sure you have those class structures set up properly. So it's not going to be a big hassle once your company grows to a decent size. And now you realize you don't have that proper structure. It's very difficult to bring them on board. Also, anytime you're running a business with a partner, it is very important to properly set up something called a shareholder agreement, which lays out all the rules and governance of how this company is going to be run or like how it's going to be resolved if shareholders run into issues. This is also a very in-depth video that I do plan to make a separate video on because sometimes a company can actually make a break solely because of a shareholder agreement being set up properly or not. However, if you do go through a lawyer route, it is obviously more expensive. On average, you should expect to pay anywhere from $1,000 to $2,000. Alright, moving on, then let's talk about who should you think about incorporating. And in my opinion, there should only be three classes of people thinking about this. Number one are people that are self-employed, such as if you're in trades, if you're a doctor or lawyer, or you're opening up a business to actually bring in active revenue. Now, second group of people are someone that are not necessarily running their own business, but they're going to be a partner and they're buying into a firm or going into a joint venture. So for example, lawyers is a very popular one where when they become from associate to a partner, they would likely make or create a corporation at that point. And finally, it is someone that is maybe running some sort of investment structure or plans that requires some additional legal protection. Now, on this note, I do want to expand a little bit because I think there is a clear misconception. A lot of people always say that, hey, if I open a corporation, it's going to shelter me from all legal responsibility. So if anything happens to me, I just close down my corporation and that's it. Like legal issues is not going to reach another level. It's going to touch me personally. This can be true or it can be not true. It really depends on what the problem is here, because more often than not, if this is an issue caused by human error, people would definitely have the legal recourse to not just sue your corporation and further on sue you personally to try to get more asset under your personal name. However, a corporation, while it's not a bulletproof solution, it does create an extra layer of protection and also create more nuances or complication when someone is actually trying to sue you. And often this will be expensive and timely enough to really deter and discourage people. In a sense, it does create some sort of protection, but it's not bulletproof. I just want to make sure everybody understands that. So if legal protection is something you're really concerned about, then you definitely want to go the lawyer route and make sure you hire a good corporate lawyer to ask them all the worst case scenarios to see how much a corporation can really shelter you from whatever issue you may run into. All right, next, let's talk about when should somebody incorporate. So there are three reasons or three thresholds when you should be incorporating. Number one is what we talked about already for legal protection purpose. Number two is if you are required to incorporate because your vendor or someone you partner with requiring you to do so. And the third threshold is after you have spent all the expenses for personal expense as well and pay all the taxes, you realize you're going to have surplus cash left over. That's often a good indication on when you should start exploring the idea of incorporation. Now, out there, if you search, there's a lot of articles talking about, and if you make anywhere around 55 to 80,000 as a self-employed, you should incorporate. While that is technically true because they're really looking at the tax rate difference between a personal tax bracket and a corporation tax bracket, this is only true if at the end you have some money left. If you don't have any money left inside your corporation, you need to pay everything out every year to pay your personal expense and taxes, then it doesn't matter if you're making 55, 80, or even 800,000. Incorporating likely will not really help you that much because the only tax advantage, which we'll explore next, it's about tax deferral, and it only can happen if you leave money inside your corporation. So next, let's talk about why should someone incorporate? What is the main advantage here? Now, there are four biggest reasons or advantages of someone incorporating. First reason why someone would incorporate is for the continuity that a corporation can provide. So today, imagine if you're running this business under your personal name, everything is under your name, your equipment, your assets, your inventory, your cash, bank accounts, all that stuff. If you were to pass away, everything under your name will need to go through probate, which can be a very time-consuming and expensive process before the next person can inherit everything and then keep running the business. However, if you have a corporation, you likely are going to have two wills, and the second one is going to be just for your corporate shares. So then if you were to die, that corporate share does not need to go through probate. It can be passed on to the next person immediately without interruption. So continuity is one of the big reasons. Second reason is for a very juicy and attractive capital gain exemption. Now in Canada, because small business is actually one of the most important aspects of the economy, small business made up I think over 50% to 60% of the total hiring inside Canada. So government really loves small business and they need small business in order for Canada to thrive. So this is why if you own a Canadian private corporation and you decide to sell this eventually, you may be able to exempt up to 970,000, this is the figure for 2023, of capital gain that you don't need to pay tax on. So if I put this into a calculator today for BC, if that's all you make for that year, just your exemption is going to help save you about $215,000 in taxes. So that's a huge amount of tax that you can skip out. And that's essentially the reward that government is giving you for taking the risk and running a small business and hiring people and making the economy run. Now, if $215,000 of tax save is very attractive to you, well, it gets better than that because not only you can use it, your spouse can use it, and your kids can also use it. So if you have a lot of family members, potential, all of them can make use of the lifetime capital gain exemption, and each of them will exempt up to $1 million of capital gain tax. However, to set this up, you obviously need a lot better planning and discussion with a planner, lawyer, and also CPA to make sure this is done properly. I'm not going to go into detail here. Again, this might be something I'll talk about more in future, but this is definitely a very attractive point. Now, on this note, make sure that in order to use the lifetime capital gain exemption, you have to sell your shares of company and not the assets. What that means is you have to sell the shares itself to someone else instead of selling all the inventory or equipment, etc. This is actually going to be more difficult for some industries because of their liability. The buyers may not be keen on buying the shares over unless you have a really good brand name and there's a lot of incentive to acquire those shares. Now, third reason we want to incorporate is because it can also provide some income split opportunities for you. Before, it is very easy because you can basically add your spouse, add your kids, and just pay everybody's salary and spread your tax that way. It is a lot more difficult to do so right now because of the new tax on split income law that I think passed 2017 or 18. We call it TOSI rule. Basically, they're saying that if you're before 65 and you're trying to split income this way, whoever you're trying to split income to, your family member has to work a reasonable hour to prove they're actually providing value for the company and getting paid at a reasonable rate, or else all those taxes all those income that you pay them is going to come back to the real shareholder, which is yourself, and you're all going to be taxed under one person and you have to pay penalty on top as well. So this has become a lot more difficult. However, it is still possible, especially if you're after 65, to have some income split opportunity there as well. So it's still somewhat attractive. Now, finally, the fourth and the most important reason to incorporate is for favorable tax treatment and tax deferral inside your corporation. For private companies in BC, the first 500K you will be taxed at 11%, and anything over 500K you'll be taxed at 27%. So this is obviously a massive tax saving upfront. If you're a person making 500K self-employed income right now, as you can see on the graph, you would be paying about $227,000 in tax in BC, whereas you only pay about $55,000 in as a corporation in BC. However, this is a tax deferral, like I said. It is not a true final tax saving. This only exists, this better tax treatment only exists for all the money that is staying inside the corporation. Because the moment you pay out to yourself, it wouldn't matter if you're incorporating or self-employed or not, you're going to pay a very similar amount of tax. This is a mechanism that CRA creates called integration. So this is why in my previous section, I said that you need to have money left inside your corporation before you think about incorporating if legal requirement is not the main concern here. All right, so now you may look at this and say, well, this is just a tax deferral. It's not a tax saving really because I have to pay myself eventually. So what is the attractiveness here? Because it seems like I have to pay the same tax anyway. Well, while that may be true, the longer you can defer this, it's going to become a very, very powerful tool. So let's look at some simple example. So on the screen there is an example of someone in BC making 500K income as a self-employed every year while having 200K of personal expense. Now I'm going to assume the same thing is going to be true for the next 10 years as a straight line. As you can see, this person would need to pay a massive amount of tax first on the 500K, then have whatever left and use that to pay your 200K. You're going to have very little money left inside your personal account. And let's say you invest this for the next 10 years. Doesn't matter, just say you were a gross return of 8%. Before tax, you'll realize that by the end of 10 years, you're going to have above K sitting in there in your personal account. Now, if you compare this to someone making the same amount of money, spending the same amount for personal, but the difference is that they're only paying themselves just enough for their personal expenses and they're going to shelter everything inside your corporation and pay that low corporate tax rate. Doesn't matter if your salary or dividend, at the end of 10 years, you are going to be left with so much more money, assuming you get the same return and assuming it's all deferred capital gain, meaning that you're not paying tax on any of your gains inside your corporation for the last 10 years. Now, this is a very simplified way of comparing, and it's also not super realistic because nobody can have 100% deferred capital gain inside corporation. It's just difficult, and from a portfolio standpoint, it doesn't make sense to do something like that. But nevertheless, it is still a really good example to showcase the power of deferring tax. And the longer you can defer, the more money you're going to be able to create on the side before you have to decide to pay tax when you pay yourself. And this is really how wealthy people is able to grow wealth in such fast pace, get that low tax rate treatment up front, and then defer. Alright, so that's the 4 main reasons on why you should incorporate. Finally, let's visit how you should be using those corporate money once you have paid all the expenses, all the taxes, and those are the retained earnings left inside your corporation. Now here, I'm going to keep it more simple, and I just want to address the most commonly asked questions is, with the corporate money or as a corporate owner, should I pay myself more to do RRSP or TFSA? And also, how should I be investing in real estate for rental properties? Do I keep it inside a corporation or do I pay myself personally? For RRSP and TFSA, the answer is actually not as clear cut because it largely depends on what kind of investment you are doing and what kind of return you're going to be getting. Is it interest, dividend, realized capital gain or unrealized capital gain? Now, CIBC actually have a really good and detailed article on these two topics. They have one for RRSP and they have one for TFSA. They go into super detail and do many different scenario and tests. For the scope or for the length of this video without running like an hour over time, I'm not going to go in detail on what they talked about. I can make a separate video just on that. But to give you a summary, the conclusion is as follows. Generally, the consensus in this research article is saying that it is worthwhile to pay yourself a little bit more to maximize your RRSP and TFSA as a corporate owner if you're planning to do majority of investment that will yield you interest return, dividend return, or a small amount of capital gain mixed with those two in there. However, if you set up your return mainly to be unrealized capital gain for long term, then it's better for you to leave those money inside your corporation and invest that way. But because of the fact that most people are likely going to have a balanced portfolio when they come to investment, so that means they have capital gain, interest, and dividend mixed in there. So it is probably better for most people to actually pay themselves to max their RRSP and TFSA. However, this is not a very clear-cut answer like I was saying, because there is other factor to come into play as well. First of all, there is the CPP and EI cost if you pay yourself salary that is going to get fairly expensive in the future. There is also the issue with the 50K limit on passive income inside corporation before you lose that 500K small business deduction. I'll make a video on a separate time talking about just on this. Also, there are other vehicles that you may want to do as well, like insurances or individual pension plan inside a corporation that might turn out to be better to shelter those money inside your corporation. This is something you have to sit down with a planner, CPA, or even a lawyer to really figure out for your long-term purpose. So again, it's not a super clear-cut answer. You have to consult for your own situation. For investment property, it may be a little bit more straightforward because you are going to have to pay quite a large down payment usually to get something. If you pay yourself personally, it will be pretty expensive and the tax rate can be very high. So in that sense, it might be more worthwhile to buy that real estate inside your corporation so you don't have to go through that step of paying yourself personally first. But again, this also really depends on your personal tax rate and what kind of properties you're buying and the down payment you need. So again, on this part, while it may make more sense to keep them inside a corporation, you really again should talk to your CPA first to make sure you understand the tax differences before you make a decision. Now, finally, on doing investment inside corporation, just so you're clear, if you are making any return through your investments, it is going to count as passive income inside your corporation most of the time. This includes your real estate that is paying you rent. There is a very niche a condition that makes it not a passive income, but I will talk more about that in other videos. Just know that if it's passive income and it's realized gain, you will be taxed at the highest personal tax bracket in your province. You will get a lot of it back because of something called return of dividend tax on hand. Again, something I'll talk about later. This is beyond the scope. However, while you will get some of these tax back, you still have to pay that huge tax liability upfront, which will make you having less money on hand to continue to invest inside a corporation. So again, a lot of stuff to be aware before you decide to invest inside a corporation or personally. Alright, so this is the end of the video. Today I just want to talk about the basics, Hopefully, if you're someone on the fence or you have never thought about incorporating and you do have that choice, it starts to get you to think about these things, because potentially it can mean a huge difference for your financial plan in the future. Now, there is also a lot of more complicated topics like how to do a estate freeze, how to do a estate planning, tax planning, or risk management, how to incorporate trust inside your corporation. All that, can be a separate video by itself. I'm gonna maybe talk about them depending on the feedback on this video. So let me know in the comment down below if you find this video helpful or any other topics you may want to hear in the future. And as always, if you like these kind of videos, make sure you like and subscribe to the channel. Click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you in the next video. Bye!